The housing market might be declining, but one of the markets that is not declining, it's been doing actually, quite well, is the stock market. So you've got a call, Bob, for S&P 1000 by year end?
Yes.
Right? So what's your outlook for the stock market?
My guess is we'll see 1,000 before the end of the year. There's a huge amount of cash on the sidelines, much of which is looking for a pullback. We may be in the middle of one right now. In fact, my view is we're going to see 800 before we see 1,000, as markets never move straight in one direction. But between pension funds and individuals with cash on the sidelines getting near zero last I checked, when markets go up, that is not a sufficient return. When they're going down, zero is just fine. When stocks are going up, I'm tempted to put some in, the average guy says, and it gets in, and that pushes stock prices higher.
You're saying that essentially between now and year end, I mean, there could be another correction, right?
Absolutely.
And a serious correction, or?
If we go to 800 to 850 on the S&P, which we think is very feasible, that's the 5 to 10% move from here, which will be painful if we live through. And maybe there's more than that because this market's been more volatile than anybody thought it would be. But the character of this rally is somewhat different. For the first time, we have earnings estimates going up, different from the last 4 rallies. For the first time, we have volume advancing on the up days and shrinking on the down days. That's different from the other 4 rallies. For the first time, we have leading economic indicators moving up. Now, we can all debate about how strong it'll be, how long it will last, but the truth is the direction's changed.
And you also have different sectors doing
Absolutely.
the work. I mean, it is actually an equity market that has been very cyclical. You know, it's been led by technology. It's been led by some of the early cyclical sectors like consumer discretionary and so on and so forth. So, you know, the underlying message of the equity market is undoubtedly that the worst is over. I don't think, you know, you just have to look at the bank stocks and the worries that are still associated with those to know that, you know, as Jeff would say, I mean, the sun's not going to come out and stay out for, indefinitely. But nonetheless, I mean, the underlying characteristics of this rally are much better.
So, Jeff, what about the credit markets? I mean, what shape are the credit markets in? Is liquidity returned? Thank you very much, Dan. Well, we have several key questions that we know that all of you want answered. How close are we to recovery? What could slow down the recovery or speed it up? And what are the critical strategies investors should consider today? So I'm going to go right to the head of the table, and that is Bob Dahl from BlackRock, and ask him the first question. Can we dispense with what was an old possibility, and that is the possibility of the Great Depression #2? Do you think that we can safely put that fear to rest?
Well, with high probability, Consuelo, you know, we're never out of the mess when deflationary forces rear their ugly head, and they're still here. So I would answer your question with 80 to 90% chance, yes.
Jeff, what would you give me?
I share Bob's view. I think the important thing is government intervention in credit markets has precluded the collapse of the financial system. And if you go back to one of the root causes of the Depression, it was letting the financial system collapse. That's the good news. The bad news is that if you look at another root cause of the Depression, it was maligned unintended consequences of government intervention. And when we look at where we are in this cycle, there's still this open chapter on exactly how is this intervention policy going to play out. And that part of it is very much in front of us.
You know, Michael Hartnett, how would you answer the question? And I might add that the policy response around the globe has been very different.
To a certain extent, you did see the Great Depression. I mean, if you actually look at the 10-year rolling returns from the S&P 500, back in March or April, I think the figure was about -3, -4% annualized. That's the worst 10-year period for the S&P 500 since 1939.
Right.
So, you know, in many ways, the history that was created just in the last 6 to 9 months, I mean, that's what we're, you know, breathing a huge sigh of relief that we're moving out of that period. And I think, you know, markets in the early part of this year are climbing, you know, the steepest wall of worry that we've seen for a very long time. And I don't think that process is over. I think that if you look around the world, China obviously is a real beacon of hope out there because you've had a very, very bold, dramatic policy response and it's working. Indeed, the first quantitative easing that we saw around the world was on March 5th. Now, quantitative easing is when the central bank really admits that it's going to print money to buy assets to make us all feel better. The Bank of England did that on March 5th. That was the day the S&P troughed. It was the day the dollar peaked, and markets have really been going up ever since.
You know, Robert Shiller, you've written a lot about the fact that actually a depression can be a self-fulfilling prophecy because you pay a lot of attention to psychology. So what's your reading of psychology and the psychology of depression?
Well, in my new book, Animal Spirits, George Akerlof and I emphasize the importance of stories in motivating. We think the economy is driven by stories that pass word of mouth. And one very important story is the Great Depression. And periodically, we get scared. As I tabulate it, this is the fourth Great Depression scare. 74, 75 was the first. 81, 82 was the second. Actually, 78 to 82 was the second. 1990 to 92 or so was the third. And these come and go regularly.
So this is nothing new at any rate, this
well,
fear.
I think that it looks scarier for people at this table than it does for the general public. The general public, maybe it's getting over it already, but we know that there are serious financial problems that have infected our banking sector, lots of our financial institutions. I don't think that those were as vivid to the general public, and that's why depression confidence, as measured by the Michigan Consumer Sentiment Survey, was not as shaken this time.
Right. So let's talk about that, because then that's the recovery scenario, but the new market reality, the new economic reality. So are you seeing pretty strong signs of recovery or not, Bob Dahl?
Absolutely. I mean, the phrase, it's well worn, green shoots are everywhere. Having said that, my reminder is when you're looking at green shoots, most of what you're looking at is brown. The background is brown. A few months ago it was kind of all brown. Now we're seeing a green shoot here and there. And whether it's consumer confidence or several months where retail sales have been better than expected, we've had earnings estimates actually move up from very low levels. That's a big change for corporate America. These are signs that we are going to get some sort of rebound on the back of the immense policy response that we've seen from almost every part of the world, led by the U.S., China, and the U.K.
And do you agree with this, Jeff?
I think the issue about green shoots is it's very different to talk about a stabilization. And clearly, and I think we'll all agree on this point, stabilization has occurred. But it's very different to look at and make an investment allocation decision based on stabilization and the lack of depression and equate that to V-shaped historic type recoveries. Here we fundamentally disagree. This is really a misunderstanding of stabilization for recovery. We're not in a period of recovery. We're in a period of having mitigated the worst case. And don't get me wrong, that's a good thing. But we don't want to take it too far to say, look at how much asset prices, especially in credit markets, have really overrun, in our view, to what is really just a stabilization story.
And stabilization at what level? That counts a lot too, right?
I think that's exactly right. And I would amend and actually agree with my colleague here that we have moved just from how big is the big black hole, does it have a bottom, to yes, it has a bottom and things are less bad. I agree. We have not gotten to good. For equity markets and other risk assets to have a sustained move up, we've got to move from less bad to actually good news. And we're not getting a lot of good news yet.
Michael Hartnett, the rest of the world. Yeah. Where are we as far as, are you seeing the green shoots of recovery or stabilization at a lower level than we would desire?
Well, I think there's three things you have to look for. It ends when consumers start to spend. It ends when banks start to lend. And I think both Bob and Jeff are indicating that that will really take some time. But I think the third thing is the rest of the world and particularly China. China can't carry the rest of the world on its shoulders. There's absolutely no doubt about that. But there is very
new market realities, and one of the things that the clients have been asking about too is this inflation-deflation debate. So Jeff, I mean, where do you come out in that debate? Are we setting ourselves up for a huge period of hyperinflation?
I think there's a concept that's missing in this debate. People talk about inflation, they talk about deflation, but there is another option, and it's one that we could very well be seeing again in markets today, and that's a real interest rate increase. So you can have interest rates rise that is not driven by inflation, nor inflation expectations. Why do real interest rates rise? Because the price for extending the U.S. government credit is going to get higher. When you demand the type of credit that we're demanding from the rest of the world to solve some of our problems. Now, we're extending the fiscal balance sheet to mitigate our problems. That's very helpful in the near term, but the long-term cost of that may be a persistent rise in real interest rates.
You know, you mentioned the amount of credit basically that we're borrowing so much money. The UK S&P just said recently that they're considering downgrading the UK's AAA credit rating. Could that happen here as well? And what kind of an impact will that have on inflation and interest rates?
I think, firstly, if people continue with the inflation, deflation, is it a depression, sort of debate, psychologically, I think you'll agree, that's really good news, because I think, again, it's this wall of worry argument that we're focusing on extremes. I mean, if it's somewhere in the middle between inflation and deflation,